Competitive Landscape, Analysis of 2025 Global Economic Strategies. Introduction. The analysis focuses on the competitive landscape for global economic strategies in 2025, particularly how the United States aims to secure a 15% market share advantage over the European Union, EU, and China by 2027. This report synthesizes data and insights from various sources, including projections from the International Monetary Fund (IMF) and other economic reports, to provide a comprehensive overview of the anticipated economic trajectories and strategic frameworks. Global Economic Outlook. The International Monetary Fund (IMF) projects global growth at 3.3% for 2025. The U.S. economy is anticipated to outperform the euro area, which is expected to grow by only 1%, hampered by low consumer confidence and high energy prices. In contrast, China's economy is forecasted to grow at 4.6%, reflecting structural challenges and uncertainties in trade policy. U.S. Economic Strategy. The U.S. intends to leverage stronger productivity growth, particularly in the technology sector, to assert its economic dominance. Increased productivity and a favorable business environment alongside deeper capital markets have contributed to this growth. However, potential shifts in policy under a new U.S. administration may introduce demand-stimulating risks such as fiscal stimulus or regulatory changes, potentially leading to increased output and inflation. Challenges facing the EU and China. The euro area encounters challenges stemming from sluggish consumer spending and ongoing geopolitical risks, particularly due to the effects of the war in Ukraine and energy price volatility. These challenges contribute to a weaker economic outlook compared to the U.S. On the other hand, China faces structural issues, including a potential debt deflation trap and demographic challenges alongside insufficient domestic consumption, which are expected to hinder its growth. Key economic indicators. U.S. growth, projected at 2.7% for 2025, driven by strong productivity growth and potential deregulation. EU growth, expected to be 1%. Limited by low consumer confidence and high energy prices. China growth, forecasted at 4.6%, emphasizing the need for a shift toward a consumption-driven economic model. Risks and recommendations. The IMF highlights the risks associated with high levels of public debt in both developed and developing economies, which could restrict fiscal space and limit responsiveness to future shocks. To sustain economic growth, restoring fiscal buffers and implementing structural reforms are recommended. Comparative analysis of sources. While the IMF provides broader economic projections and risk assessments, additional insights into sectoral performances or corporate strategies could be drawn from sources like S&P Global. However, access to such specific data was denied, limiting a full comparative analysis. Summary. In summary, the U.S. strategy for economic growth by 2027 is centered on enhancing productivity while navigating potential policy shifts. The contrasting trajectories of the US, EU, and China reveal the complexities of the global economic landscape as countries respond to evolving challenges and opportunities. Detailed economic strategies and perspectives. U.S. economic strategy. The U.S. aims to achieve its 15% market share target through several strategic initiatives. 1. Enhancing productivity. The U.S. is focusing on sectors like technology, where productivity growth has outpaced that of the EU and China. This is facilitated by a favorable regulatory environment and access to venture capital. 2. Fiscal and monetary policies. The potential for fiscal stimulus under the new administration could stimulate demand, though it may also lead to inflationary pressures. The Federal Reserve's monetary policy decisions will be crucial in managing inflation while supporting economic growth. 3. Trade policies. The U.S. is likely to adopt measures that protect its domestic industries while engaging in strategic alliances to ensure a competitive edge in global markets. EU economic challenges. The EU faces a myriad of challenges that could hinder its economic growth. 1. Low consumer confidence. Persistent inflation and high energy prices are dampening consumer spending, which is crucial for economic recovery. 2. Geopolitical risks. The ongoing war in Ukraine and broader geopolitical tensions have created an uncertain economic environment, further complicating recovery efforts. 3. Need for structural reforms to boost productivity. The EU must address structural issues such as resource misallocation and a lack of innovation in key sectors. China's economic landscape. China's growth trajectory is undergoing significant changes. 1. Structural economic changes. The shift from an export-driven economy to one focused on domestic consumption is essential. However, this transition has been slow and is complicated by demographic trends and rising debt levels. 2. Debt deflation risks. Concerns about a potential debt deflation trap could stifle growth, necessitating careful management of fiscal policy and consumer demand. 3. Trade relations. Continued tensions with the U.S. and other trading partners could impact China's ability to sustain growth rates, requiring a re-evaluation of its trade policies. Conclusion. The competitive landscape for global economic strategies in 2025 highlights the distinct paths of the US, EU, and China as they navigate an increasingly complex economic environment. The US aims to leverage productivity gains and potential policy shifts to secure a significant market share advantage, while the EU and China face their unique sets of challenges that could impede growth. Moving forward, the ability of these economies to adapt to changing circumstances and implement effective strategies will be critical in shaping their economic futures. The content provides a detailed analysis of the competitive landscape for global economic strategies in 2025, focusing on the U.S. ambitions to achieve a 15% market share advantage over the EU and China by 2027. A few counterintuitive insights emerge from the information provided. 1. Divergent growth rates. While conventional wisdom might suggest that emerging markets like China would consistently outpace developed economies such as the US and EU, the analysis indicates that the US is projected to grow at 2.7% in 2025, significantly outperforming the EU's expected growth of only 1%. This is surprising given the historical context where emerging markets typically experience faster growth rates. 2. Potential inflation as a growth catalyst. The U.S. strategy involves potential fiscal stimulus and deregulation, which could lead to increased output and inflation. Typically, inflation is viewed negatively as it erodes purchasing power, but in this context it may serve as a catalyst for economic growth, challenging traditional perspectives on inflation's role in economic health. 3. China's consumption-driven model. The expectation that China must pivot to a more consumption-driven growth model contradicts the narrative that export-led growth is always superior for large economies. The IMF suggests that despite structural changes, continued reliance on external trade may hinder China's economic sustainability, which runs counter to the common belief that export growth is paramount for large economies. 4. Debt dynamics and economic health. The IMF warns of high public debt levels as a concern for both advanced and developing economies. This raises a counterintuitive point. While high debt is generally viewed as a risk, the analysis suggests that the real danger lies in the inability to respond to economic shocks linked to high debt, indicating that governments may need to limit growth to manage fiscal health, challenging the idea that all growth is inherently beneficial. 5. Regulatory rollback risks. The suggestion that deregulation could lead to increased output but also financial vulnerabilities is a nuanced perspective. It challenges the prevailing notion that deregulation is always positive for economic growth, highlighting that while it may stimulate growth in the short term, it could also set the stage for future economic instability. 6. Global trade stability. The report indicates a stable relationship between global trade and GDP, contradicting expectations that trade volumes would continually rise in tandem with global growth. The anticipated downward revision in global trade growth due to increasing trade policy uncertainty suggests a more cautious outlook on globalization than previously assumed. 7. U.S. long-term yields and financial conditions. The analysis highlights that the rise in U.S. long-term yields despite the Federal Reserve's easing reflects market nervousness about future fiscal policies. This suggests a counterintuitive relationship where monetary policy easing does not necessarily lead to lower yields. Challenging conventional views on interest rates and monetary policy dynamics. 8. EU structural issues. The emphasis on the EU's lack of productivity growth relative to the US and the structural issues within the EU economy challenges the assumption that mature economies uniformly benefit from technological advancements. It suggests that the EU's economic framework may hinder its ability to innovate and compete contrary to expectations of competitive parity with the US. These points illustrate a complex and often counterintuitive landscape in the global economy where traditional narratives about growth, debt, and regulatory environments are being challenged by emerging trends and analyses. The competitive landscape analysis regarding the U.S. strategy to outpace the EU and China by capturing a 15% market share advantage by 2027 highlights several significant insights that may often be overlooked. Here are some key points of discussion, along with their significance. 1. Divergence in growth rates. The projections indicate that the US is expected to grow at 2.7% while the EU is at a mere 1% and China at 4.6%. This stark contrast is critical as it suggests a realignment of global economic power. The US is leveraging productivity growth, particularly in technology, to drive its economy forward. The underlying causes of these growth rates should not be overlooked. They reflect deeper structural differences in economic resilience and adaptability. Significance. The ability of the U.S. to maintain a higher growth trajectory can lead to increased investment opportunities, better job creation, and enhanced global influence. The sluggish growth in the EU, driven by high energy prices and low consumer confidence, signals potential economic instability that could have wider implications for global trade and investment patterns. 2. Productivity as a key driver. The report emphasizes that the U.S. productivity growth has been stronger than its counterparts, particularly in the technology sector. While many focus on GDP growth, productivity is a more telling indicator of long-term economic health. Significance. Strong productivity growth can lead to higher wages and improved living standards, which in turn fuels consumer spending. If the U.S. continues to foster environments conducive to innovation and efficiency, it could further solidify its economic dominance over the EU and China. 3. Risks of policy shifts in the U.S. The analysis points out that potential policy shifts under a new U.S. administration could introduce demand-stimulating risks, including fiscal stimulus, which might lead to inflation. This nuance is important as it indicates that political changes can have immediate and significant impacts on economic outcomes. Significance. Understanding these dynamics is crucial for investors and policymakers alike. They need to evaluate the potential for increased volatility in U.S. markets based on political climate changes. Additionally, the risks associated with deregulation could lead to financial vulnerabilities which could undermine the gains made in productivity. 4. China's economic challenges. China's forecasted growth of 4.6% still represents a significant slowdown from its historical averages. The concerns regarding a debt deflation trap and insufficient domestic consumption are critical points that could affect global supply chains and trade dynamics. Significance. As China attempts to pivot towards a consumption-driven model, its success or failure will have profound implications not just for its economy but for countries that are economically tied to it, particularly in the developing world. If China fails to manage its economic transition effectively, it could lead to decreased demand for imports, impacting global trade flows. 5. High public debt concerns. The IMF report emphasizes the risks associated with high public debt levels in developed and developing economies, highlighting that restoring fiscal buffers is essential for sustained economic growth. Significance. High levels of debt can limit a government's ability to respond to economic shocks, thus increasing vulnerability. This point may be overlooked in favor of immediate growth metrics. However, the long-term implications of fiscal irresponsibility can lead to crises that destabilize economies and disrupt global markets. 6. Underperformance of the EU. The EU's projected growth of just 1% is attributed to several factors, including sluggish consumer spending and geopolitical risks. The report also points to structural issues within the region, such as a lack of productivity growth and the challenges of integrating member states economically. Significance: the EU's struggles may lead to a re-evaluation of its economic policies and the efficacy of its governance structures. This could create an opportunity for the US to increase its influence in Europe, particularly if the EU fails to address its internal challenges effectively. 7. Missed opportunities in emerging markets. The report indicates that while China's growth is slowing, growth potential in other emerging markets is increasing. However, these markets are also facing challenges from high debt levels and inflation. Significance: investors should not overlook opportunities in these emerging markets, as they may offer higher growth potential compared to developed economies. However, the inherent risks associated with these markets necessitate careful analysis and strategic investment. 8. Geopolitical tensions and trade policy uncertainty. The report highlights that trade policy uncertainty remains a significant risk factor affecting global growth. The implications of geopolitical tensions, particularly in light of the war in Ukraine, could reshape trade relationships and market dynamics. Significance: businesses and investors must stay vigilant regarding how geopolitical events can affect market conditions. A shift in trade policy could alter competitive advantages and supply chain strategies, necessitating adaptive strategies for businesses operating internationally. 9. Impact of inflation on central bank policies. The potential for renewed inflationary pressures poses a significant risk to U.S. economic policy. If inflation expectations become de-anchored, it could complicate the Federal Reserve's ability to manage monetary policy effectively. Significance: understanding the interplay between inflation and monetary policy is crucial for predicting future economic conditions. Higher inflation could lead to increased interest rates, which may stifle economic growth and impact consumer behavior. Conclusion: the analysis of the competitive landscape for global economic strategies reveals several critical factors that have significant implications for policymakers, investors, and businesses alike. Understanding these nuanced elements, particularly those that are often overlooked, is essential for navigating the complexities of the global economy. The interplay of productivity, public debt, geopolitical tensions, and consumer sentiment will shape the trajectories of the US, EU, and China as they vie for economic supremacy in the coming years. 1. US economic strategy and growth projections. The US is projected to grow at 2.7% in 2025, significantly outpacing the EU's expected 1% and China's 4.6%. This growth is largely attributed to stronger productivity, particularly in the technology sector, and a favorable business environment. However, potential policy shifts under the new administration pose risks, particularly related to inflation and fiscal stimulus. This aspect of the analysis provides a fundamental insight into how U.S. strategies could reshape the global economic landscape and the implications for international trade dynamics. 2. Challenges faced by the EU and China. The EU's sluggish growth, projected at just 1%, is attributed to low consumer confidence, high energy prices, and geopolitical risks. In contrast, China's growth forecast of 4.6% is hindered by structural challenges like a debt deflation trap and demographic shifts. Understanding these challenges is crucial for analyzing the competitive landscape, as it highlights the vulnerabilities each region faces. Influencing global market share and economic positioning by 2027. 3. Risks associated with high public debt. Both developed and developing economies are grappling with high public debt levels, which limit fiscal space and responsiveness to economic shocks. The IMF stresses the importance of restoring fiscal buffers and implementing structural reforms for sustained growth. This point warrants in-depth discussion as it touches on the broader implications of fiscal health on economic stability and growth prospects across different regions, particularly in the context of rising interest rates and global economic uncertainties. 4. Global economic outlook and divergence. The IMF's projection of global growth at 3.3% for 2025 reflects a stabilization following major disruptions from the pandemic and geopolitical events. However, significant divergences among advanced economies, particularly between the US and the EU, raise questions about the future of global trade and investment flows. Analyzing these divergences will reveal underlying trends that could shape economic strategies and competitive positioning leading up to 2027, making it a key focus for stakeholders in international markets. Here are 3 famous historical cases that illustrate competitive economic strategies and geopolitical maneuvering similar to the content outlined above. 1. The Cold War economic rivalry 1947 to 1991. The Cold War period marked a prolonged geopolitical tension between the United States and the Soviet Union characterized by ideological, military, and economic rivalry. Each superpower aimed to expand its influence globally, with the US promoting capitalism and democracy while the USSR advocated for communism. A significant aspect of this rivalry was the Marshall Plan implemented by the US in 1948, which provided economic assistance to Western European nations to bolster their economies post-World War II. This strategy not only helped to rebuild these economies but also aimed to prevent the spread of communism by creating stable and prosperous democratic states. The economic strategies employed during the Cold War were critical in shaping the global order and establishing the US as a dominant economic power by the end of the 20th century. 2. Japan's economic miracle 1950s to 1990s. Post-World War II, Japan experienced rapid economic growth, often referred to as the Japanese economic miracle. This period was characterized by significant government intervention in the economy, strategic planning, and export-led growth. The Japanese government, through the Ministry of International Trade and Industry (MITI), played a pivotal role in identifying key industries for development, investing in technology, and fostering cooperation between the government and private sector. Japan's focus on high-quality manufacturing, particularly in electronics and automobiles, allowed it to gain substantial market share globally, outpacing competitors like the United States and Europe during this time. The strategies implemented during this period serve as a notable example of how targeted economic policies can lead to significant competitive advantages in the global market. 3. The rise of China in the global economy 2000s present. Since the late 20th century, China has rapidly transformed into a global economic powerhouse, largely due to its strategic economic reforms initiated in the late 1970s under Deng Xiaoping. By adopting a socialist market economy, China opened its doors to foreign investment, joined the World Trade Organization (WTO) in 2001, and became a major manufacturing hub for global supply chains. The Chinese government has also implemented strategic initiatives such as the Belt and Road Initiative (BRI), aimed at enhancing global trade connectivity and expanding its influence across Asia, Europe, and Africa. China's economic strategy has allowed it to challenge the US and EU for global market share, leading to significant geopolitical tensions and trade disputes, particularly regarding intellectual property and trade imbalances. The ongoing competition between the US and China reflects historical patterns of economic rivalry and strategic maneuvering on the global stage. The future economic landscape is poised for significant shifts as the United States aims to outpace the European Union, EU, and China in market share by 2027. Here are the key predictions and insights surrounding this competitive dynamic. 1. Projected economic growth rates. United States, expected GDP growth of 2.7% in 2025, driven by robust productivity, especially in technology sectors, and favorable business conditions. This growth trajectory positions the U.S. to capitalize on emerging technologies and innovation. European Union, growth is projected at a meager 1% due to low consumer confidence, high energy prices, and sluggish spending exacerbated by geopolitical uncertainties. China, anticipated growth of 4.6% reflects ongoing structural challenges, including a transition towards a consumption-driven economy which remains a work in progress. 2. U.S. economic strategy. The U.S. strategy centers on productivity enhancement. Continued investment in technology and innovation is expected to bolster productivity, making the economy more competitive on a global scale. Policy shifts. Potential changes under the new administration could involve fiscal stimulus and regulatory reforms aimed at promoting growth. Although such policies carry risks of inflation and increased public debt. Infrastructure investment. Significant investments in infrastructure and green technologies are anticipated to enhance economic output and job creation. 3. Challenges facing the EU and China. EU's economic hurdles. The euro area's growth is stifled by structural issues including an aging population, high energy dependency, and a lack of dynamism in its tech sector. The EU must enhance its single market and foster innovation to remain competitive. China's structural issues. China faces a potential debt deflation trap and demographic challenges that hinder its growth. The need for a consumption-driven model is urgent as reliance on exports becomes increasingly unsustainable. 4. Market dynamics. Trade and investment. The U.S. aims to enhance its trade relations and attract foreign investment, particularly in technology and green energy sectors. This could lead to a more significant market share relative to the EU and China. Currency and inflation. A stronger U.S. dollar driven by higher interest rates and economic performance may create inflationary pressures globally, impacting emerging markets that rely on dollar-denominated goods. 5. Global economic risks. The IMF highlights several risks that could impact this competitive landscape. High public debt. Elevated debt levels in both developed and developing economies could constrain fiscal policies, limiting responses to economic shocks. Trade policy uncertainty. Ongoing trade tensions and protectionist measures could disrupt global supply chains and affect market stability. Geopolitical tensions. Continued geopolitical risks, including conflicts like the war in Ukraine, could destabilize markets and impact economic recovery efforts. 6. Policy recommendations. To navigate these challenges and maintain a competitive edge, countries should restore fiscal buffers. Governments need to prioritize fiscal responsibility to maintain economic resilience against potential shocks. Implement structural reforms. Focus on enhancing competition, innovation, and productivity through targeted reforms in various sectors. Strengthen multilateral institutions. Rebuilding trust in global economic institutions could facilitate more stable international trade and investment. Conclusion. The competitive landscape of the global economy by 2027 will be shaped by the U.S.'s strategic initiatives aimed at outpacing the EU and China. While the U.S. appears poised for growth, the EU and China face significant structural challenges that could hinder their economic performance. Addressing high public debt, fostering innovation, and navigating geopolitical risks will be critical for all players in this evolving economic landscape. The outcome will depend on effective policy implementations and the global response to emerging challenges.